Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me on the phone from Nasdaq's Rockville, Maryland office, we have Jay Gragnani. He's the head of research and client engagement with Nasdaq Dorsey Wright. And we're going to take a look at how the markets have really changed the way asset allocation comes into play. Jay, it's great to have you with me as always. And you know, when you joined me in February, what a difference a month makes with the volatility that we've seen come back into the market.
What a difference a month has made, and really, Jill, what a difference the past 2 weeks has made, and then that's where all the volatility has come. It's hard to believe that 2 weeks ago we were talking about, back on the 19th, so 14 trading days, that the market's sitting at new all-time highs, and here we are talking that the S&P 500 has fallen, close to 19% on that, closing high to most recent low basis today. So you're absolutely right. I mean, it's been a quick and a very fast correction we've seen.
All right, let's take a look at the first chart that you have for us today, the S&P 500. What's the price action telling you there?
Yeah, so this you're looking at there's the S&P 500, a point and figure chart on the S&P 500, and I mentioned back on February 19th is when the S&P 500 peaked at 3380, and most recently falling to 2740, and that 2740 area has served as an area of support now for the third time, falling to 2740 in March of 2019. In June of 2019, and most recently, just yesterday, March 9th of 2020, having reversed up with today's market action so far, and assuming we hold above 2720, that reversal up will hold true. And so, that area is going to be a very important area going forward as we watch for support, watch it to see if the market is able to hold that 2740 area there. Given the pickup in volatility, I mean, it's certainly not outside the realm of possibilities that it could fall below that very quickly. But nonetheless, that is something we're watching. And that final move down, just to kind of put yesterday, the 9th, into perspective, one of the worst days, obviously, that we've seen in the market, the worst day since '08, down 7.6%. But it wasn't just within the index. It was with tons of stocks, too, Jill. And you go back and you look yesterday on March the 9th, you saw 1,600 new lows, new 52-week lows made for the market. And, that, again, coming off a period where we're just 14 trading days removed from all-time highs in the market, and we're seeing 1,600 new lows show up for the market, and that is the most that we've seen in any one day since 2008. So to put that 1,600 number into perspective, it is a massive number that we saw. So a lot of damage done, certainly yesterday, with respect to some individual names.
All right, let's move on to your next chart here. Bullish percent for NYSE. What are you taking a look at there? I don't think I've ever heard of that chart before.
So the bullish percent, what that is measuring essentially is the participation in the market. And so it's looking at the percentage of stocks that are on buy signals on their individual point and figure charts. So right now, most recently, this chart has fallen in a column of O's all the way. It reversed down at the end of January, January 31st. This chart reversed into a column of O's, and that's that circle there on the right-hand side, reversed into a column of O's, and has since fallen as more stocks have simply moved to sell signals, individual sell signals on their charts. And so that reversal down came at the end of January, was actually, ahead of the market moving to new highs. For the next couple of weeks, the indexes moved to new highs, but underneath the surface of just the broad indexes, individual stocks were breaking down, were giving sell signals. We have now since most recently fallen down to 14%, which is a very, very oversold, very washed out condition for the market, a number and a reading that we haven't seen. You have to go back to the bottom that we saw in March of 2009 to see a reading lower than we're looking at on that bullish percent chart today. And so what we're looking at there, we violated the December lows from last year, from December of 18, the January 2016 lows, the August 2011 lows, all the way back to 2009. And those other market environments, those marked ultimately bottoms in the market, obviously, as did March of 2009. 109. So certainly we'll continue to watch, but in terms of things that we're watching today, things that we're watching for a bottom to be put in this market, this would be one of those indicators that we're watching very, very closely for reversals up in.
All right, now.
What that's going to tell us, what that's going to tell us, Jill, briefly, is that if this chart is able to reverse up, it means that more stocks are moving to buy signals on their chart, which is indicative of net new demand coming back into the market, and that's what's ultimately going to lead to a bottom being put in, is seeing net new demand come off the sidelines.
All right, got it. And our last chart, and probably our most important chart, dynamic asset level investing, what we call DALI here. This is really the crux of what we're talking about today, how these volatile markets have altered the way that asset class allocations look, because for the past 6 months that you and I have been doing this together, it really has not changed much in terms of structure. It did this month.
You're absolutely right. I mean, we were going on 4 years since August of 16 without really seeing any material changes within the rankings. One thing that hasn't changed, U.S. equities from a long-term leadership position is still sitting there at number one. Again, when you put into context what we've seen so far in the market here recently, down about 18-19% from its all-time highs, not something that we haven't endured during this bull market run that we've seen, and so not surprising to see U.S. still holding on to that long-term leadership. But what we've seen is, by and large, is international markets, with a big downdraft yesterday, falling all the way down from number 2 at the beginning of February now to number 5 in terms of its leadership, and the weakness from international equities was really overtaken by some of the safer haven, typically lower beta asset classes, fixed income sitting up there at number 2, and then cash at number 3. The fixed income market's obviously being driven very heavily by the Treasury side of that equation, with interest rates dropping just to historically low levels, where nonetheless the drop in interest rates, the strength in Treasuries have caused fixed income to move up into that number 2 position behind U.S. equities.
All right, Jay, great to have you with me. As always, hope to get back to Market Site soon.
Look forward to seeing you soon, Jill.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.